NXP Semiconductors, ticker NXPI on the NASDAQ. The most embedded chip inside the modern car, powering ADAS radar sensors, EV battery management, and software-defined vehicle architectures.
Spun off from Royal Philips in 2006, headquartered in Eindhoven, Netherlands, 34,000 employees, supplies chips to every one of the top 25 global automotive OEMs.
NXP's roots trace to 1953 when Royal Philips established its semiconductor division. The arm grew for 5 decades before KKR-led investors acquired it from Philips for $9.4 billion in 2006 as NXP Semiconductors.
NXP went public on NASDAQ in 2010, beginning its transition from a broadline chip maker to a focused automotive and IoT semiconductor company, a repositioning that took a decade to fully execute.
In 2015, NXP acquired Freescale Semiconductor for $11.8 billion, doubling its automotive market share and becoming the #1 automotive chip supplier in the world by revenue.
In 2018, Qualcomm's proposed $44 billion acquisition of NXP was blocked by China's MOFCOM, the sole regulatory veto that killed the deal. NXP returned to operating independently with a strengthened position in automotive.
Kurt Sievers became CEO in 2020 after 25 years at NXP and Philips Semiconductors. He accelerated the software-defined vehicle platform strategy and launched the S32 vehicle processing architecture.
In 2022, NXP launched its S32 vehicle compute platform, designed as the central processor hub for next-generation software-defined vehicles. BMW and GM were among the first OEMs to standardize on the platform.
NXP generated $12.61 billion in fiscal 2024 revenue. Automotive accounts for 55%, $6.94 billion. Industrial and IoT add 16%. Communications infrastructure and other segments contribute the remaining 29%.
Adjusted EBITDA margin reached 34.2%. FCF conversion runs above 75% of adjusted net income, reflecting the capital-efficient fabless model that outsources wafer manufacturing to TSMC and Samsung.
The automotive design win lock-in is NXP's primary moat. When an OEM specifies an NXP chip into a new vehicle platform, that chip ships in every unit of that model for 7 to 10 years. The qualification process costs millions and takes to 36 months.
NXP holds leading market share in 77 GHz automotive radar chips used in adaptive cruise control, emergency braking, and lane-keeping systems. As ADAS penetration climbs toward 100% of new vehicles, the addressable market compounds each model year.
NXP has raised its dividend for 7 consecutive years. Starting at $2.25 annually in 2017, the dividend reached $4.36 annually by 2024, at a current yield near 2.4%.
The total annual payout reached $1.13 billion in 2024. FCF conversion above 75% provides strong dividend coverage, and NXP has maintained this payout discipline through both the automotive chip shortage of 2021 and the inventory correction of 2023.
NXP leads the competitive radar on automotive design win depth at 92 and software-defined vehicle platform positioning at 88. Texas Instruments leads on dividend consistency and balance sheet strength, reflecting its longer capital return track record.
ON Semiconductor leads on EV power device exposure. NXP's 10 billion-plus NFC chips deployed in contactless payment cards and smartphones globally generate durable recurring revenue as devices refresh every 3 to 5 years. NXP operates manufacturing in 30-plus countries with 10-plus manufacturing sites. The company employs over 10,000 design engineers focused on automotive-grade chip reliability requirements that consumer chip makers do not face.
Kurt Sievers holds a PhD in physics from RWTH Aachen University. He joined Philips Semiconductors in 1995 and spent 25 years in automotive product and business development before becoming CEO.
Sievers served as EVP and president of NXP's automotive business from 2008 to 2015, then as president and COO before becoming CEO in 2020. He is the architect of the S32 software-defined vehicle platform that is now a multi-OEM standard.
China revenue concentration at 39% is the primary geographic risk. Tariff escalation and domestic substitution pressure create uncertainty about the long-term sustainability of China's contribution to NXP's revenue mix.
Every tap-to-pay NFC transaction runs through NXP Silicon. Over 10 billion chips in the field generate recurring revenue as payment cards, phones, and terminals refresh on 3 to 5 year replacement cycles.
NXP supplies chips to every major automotive OEM on Earth, every adaptive cruise control system, every EV battery management unit, every tap-to-pay terminal, in a business where design wins, secured today, generate revenue for the next decade.
The China concentration is the thesis risk. 39% of revenue from a single geography facing tariff escalation and domestic substitution pressure is the number that keeps analysts up at night. And the long-term case depends on whether NXP's technical lead in software-defined vehicle platforms survives competitive pressure long enough to diversify that revenue base.
NXP Semiconductors, ticker NXPI, jumped 11.4% today. Q1 earnings beat on EPS, Q2 guidance came in 5% above consensus, and the data center inflection story is becoming undeniable.
Adjusted EPS of $3.05 beat the $2.97 estimate. Revenue of $3.18 billion came in a touch light versus $3.22, a 1.2% miss, but the forward guidance erased that concern entirely.
NXP traces its roots to Philips Electronics in 1953. Today, it is the world's #1 automotive chip supplier, sitting at $193 per share with 35% analyst upside to consensus target.
Hudson and I will break down whether Q1 was good enough to justify that premium. Let's go.
3 things changed structurally this quarter. First, the MEMS sensor business divestiture closed, $878 million in proceeds, and an asset that was dragging automotive margins is now gone.
The MEMS sale distorts reported automotive growth. Adjusted for the divestiture, automotive grew 10% year over year, not the 6% headline number. The core auto chip business is accelerating faster than the top line suggests.
Second structural shift, data center. NXP booked $200 million in data center revenue all of 2025. The 2026 target is $500 million, a 2.5 times inflection in 1 year.
The data center expansion uses NXP's IMX and Layerscape chips for server control plane applications, cooling, power management, board control. Automotive-grade reliability standards are a moat in high-reliability server environments where consumer chips are not qualified.
Third, leadership. Rafael Sotomayor took over as president and CEO in 2025, succeeding Kurt Sievers. Sotomayor's first full guidance cycle came with conviction. The Q2 midpoint landed 5% above street estimates.
Q2 guidance, $3.35 to $3.55 billion, midpoint $345 versus consensus at $328. Non-GAAP operating margin guided 33.8 to 35.6%, implying sequential margin expansion.
Balance sheet improvement accelerated. NXP retired $500 million in debt during Q1 and another $750 post-quarter. Net leverage is now 1.7 times adjusted EBITDA, the lowest since before the Freescale acquisition.
Q1 2026 revenue $3,181 million. That is up 12.2% from $2.835 billion in Q1 2025, against the $322 estimate, a 1.2% miss.
Context on the miss, it was MEMS related. Strip the divested product revenue and core chip revenue lands in line with organic growth expectations of 11 to 12%. The miss was accounting, not demand.
Adjusted EPS $3.05 versus the $2.97 estimate, a 2.7% beat. GAAP EPS was $4.43, elevated by the $878 million MEMS divestiture gain. Use the $3.05 for operating comparison.
Non-GAAP gross margin, 57.1%. That is 130 basis points above Q1 2025 and tracking toward the company's 60% target for 2028.
Non-GAAP operating margin, 33.1%, 110 basis points above Q1 last year. Each 100 basis points of gross margin expansion equals approximately $127 million in additional annual operating income.
Free cash flow, $714 million, 22.4% of revenue. Operating cash flow was $793 million. CapEx was only $79 million, reflecting the fabless model where TSMC and Samsung handle wafer production.
Automotive segment, $1.782 billion, up 6% reported, adjusted for MEMS, plus 10%. Industrial and IoT, $628 million, up 24%, the fastest growing segment this quarter.
Mobile, $391 million, up 16%. Communications, infrastructure, and other, $380 million, up 21%. This is where data center revenue lives. The segment growth rate is accelerating.
Capital return in Q1, $358 million total. Dividends, $256 million at $1.01 per share quarterly. Buybacks, $102 million under the existing repurchase program.
Market reaction. NXP surged 11.4% on earnings day. Options had priced in a 4 to 5% move. The actual move more than doubled the implied volatility expectation, a strong post-earnings re-rating signal.
Q2 guidance, revenue $335 to $355 billion, adjusted EPS $329 to $372. Both revenue and earnings guidance were above analyst consensus by meaningful margins.
Net leverage, 1.7 times adjusted EBITDA. Interest coverage above 14 times. The balance sheet has room for acquisitions or accelerated buybacks, as free cash flow compounds at $700+ million per quarter.
Leadership note for listeners of the chapter: the CEO has changed. Rafael Sotomayor replaced Kurt Sievers as president and CEO in 2025, succeeding the executive who spent 25 years building NXP's automotive platform strategy.
Sievers was the architect of the S32 software-defined vehicle platform that BMW and General Motors standardized on. Sotomayor inherits a company mid-transformation, design wins locked, data center expansion underway, margin expansion path defined.
Sotomayor's first full earnings cycle came with strong guidance. The S32 customer commitments are long cycle, 7 to 10-year programs that do not depend on who is running the company quarter to quarter.
Key watch. Does Sotomayor accelerate or deprioritize the data center push? Q1 commentary reinforced the $500 million target for 2026. Strategic continuity appears intact.
Revenue mix shift this quarter. Automotive dropped from 59% of revenue a year ago to 56% now. Not because automotive declined. All three other segments grew faster, improving diversification. Adjusted
EBITDA, approximately $1.21 billion for Q1, a 38% EBITDA margin. That tracks above the 34.2% full-year 2024 level, signaling operating leverage as revenue scales.
Non-GAAP operating income, $1.053 billion. Net interest expense around $130 million. The blended effective tax rate is in the low to mid-teens, reflecting the Netherlands holding company structure.
FCF conversion, $714 million divided by adjusted net income of approximately $793 million equals 90%. That is well above the company's 75+% target range.
Forward EPS projection, Q1 adjusted EPS of $305 plus Q2 midpoint of $350 equals $655 for H1. If H2 runs at a similar $350 pace, full year 2026 EPS lands around $13.55.
At $193 per share against $13.55 projected EPS, that is a forward price-to-earnings multiple of 14.3 times. Compare that to Texas Instruments at 30 times. NXP is trading at a significant sector discount.
Data center math. If Q1 Comm Infra revenue of $380 million ran at a 21% year-over-year growth rate, data center contributed approximately $115 to $120 million in Q1 alone, annualizing to $460 to $480 million, on track for $500.
Automotive content thesis in numbers. Global vehicle production was roughly flat year-over-year in Q1 2026. NXP's adjusted auto revenue grew 10%. That is 10+ percentage points of content growth per vehicle. Design win economics working as modeled.
Cash position $3.7 billion, total debt $11.7 billion, net debt $8 billion. Post-quarter debt retirements of $750 bring net debt towards $7.25 billion by mid-2026.
Dividend sustainability. Annual dividend of $4.04 against projected full-year EPS of $13.55 equals a payout ratio of 30%. 7 consecutive years of dividend growth with comfortable coverage.
Margin expansion path to 60% gross margin by 2028. BSMC and ESMC joint ventures reduce wafer costs. Each 100 basis points of gross margin adds approximately $127 million in annual gross profit at current revenue.
Overall, NXP Semiconductors' financial health is strong. Sub 2 times leverage, 90% FCF conversion, sequential margin expansion, and growing capital returns signal a company that has reloaded for a multi-year earnings growth cycle.
Peer spread this quarter. Texas Instruments posted 19% revenue growth versus NXP's 12%. TXN trades at 30 times earnings, nearly double NXP's 14.3 times. The valuation gap is the market pricing in TXN's dividend consistency and balance sheet track record.
Microchip Technology delivered 10.8% sequential revenue growth, recovering from inventory trough. MCHP is a pure microcontroller play with similar auto exposure but no S32 software-defined vehicle platform differentiation. Forward PE around 20 times.
On Semiconductor came in negative 11.2% year over year, still working through automotive power device inventory. ON's silicon carbide EV exposure is a long-term positive, but Q1 2026 recovery lagged NXP's 12% growth by 23 percentage points.
The peer surprise spread says something important. NXP at plus 12 versus ON at minus 11. Same automotive semiconductor end market, divergent execution. The difference is NXP's data center diversification and segment mix.
Valuation positioning. NXP at 14.3 times forward earnings is the cheapest of the three. TXN at 30 times prices dividend consistency. MCHP at 20 times prices inventory recovery. NXP's discount reflects China concentration and CEO transition uncertainty.
Gross margin comparison. NXP at 57.1% leads on semiconductor at 45% by over 1,200 basis points. That margin structure reflects NXP's higher value automotive radar and S32 compute mix versus ON's power device business.
EV EBITDA. NXP at 12 times is at a discount to TXN's 17 times and in line with MCHP. For a company growing revenue at 12% with margin expansion, 12 times EBITDA does not price the data center optionality, which may be effectively free at current valuation.
China at 39% of revenue is the primary thesis risk. Huawei's automotive chip division and BYD Semiconductor are building competing capabilities. If domestic substitution accelerates at Chinese OEMs, NXP faces a revenue cliff with no near-term replacement.
Tariff escalation adds a second China layer. U.S.-China trade deterioration could affect NXP's ability to supply Chinese automotive OEMs directly or invite retaliatory restrictions. The company has not quantified specific tariff exposure in its guidance.
The 1.2% revenue miss matters at a 15-plus times multiple. NXP is priced for execution. Any quarter where revenue misses by more than 1 to 2% without offsetting guidance strength creates meaningful selling pressure.
Automotive chip inventory. OEMs and Tier 1 suppliers still carried elevated stock after the 2023-2024 correction. A vehicle production slowdown in H2 2026 would trigger inventory drawdowns before new NXP orders are placed.
CEO transition risk. Sotomayor is early in his tenure. Customer relationships at BMW, GM, and Volkswagen, built by Sievers over 25 years, are the strategic asset. Disruption risk in those relationships is unquantifiable from the outside.
Valuation sensitivity at 14.3 times forward PE, NXP prices in the $500 million data center target landing and automotive content at 10+% per year. If data center runs at $350 million instead, the multiple compresses toward 12 times, closer to 165 than 193.
Options context. Implied volatility priced a 4 to 5% post-earnings move. Actual was 11.4%, more than double the implied. Traders who missed the print are now chasing. Any guidance reduction at the July print hits a structurally overpositioned market.
29 analysts cover NXP, 24 are buy or strong buy, 5 are hold, 0 sells. Consensus target $261, 35.3% above the current price of $193.
Post-earnings, analysts reiterated targets in the 240 to 280 range. Data center inflection and strong Q2 guidance were the primary cited drivers. MEMS divestiture proceeds recycled into debt reduction received credit-positive commentary.
The bear analyst camp, hold ratings from Morgan Stanley and a handful of others, wants 2 consecutive revenue beats before crediting the forward multiple. The 1.2% Q1 miss, though explained, keeps this group cautious.
Bull analysts model Q2 guidance at 350 midpoint against consensus 328, a 5% premium. If NXP beats Q2, the FY 2026 EPS trajectory supports 18 to 20 times earnings, implying 240 to 260 without sector multiple expansion.
Data center revisions drove model updates. Pre-earnings, Street modeled 300 to 350 million for the full year. Post-earnings with 500 million guidance intact, Comm Infra segment estimates moved higher, adding 15 to 20 cents in annual EPS to consensus models.
Dividend consensus. No analyst models a cut. The 30% payout ratio against 1355 projected EPS gives coverage of 3.3 times earnings. Most analysts expect the quarterly dividend to reach $1.15 to $1.20 per share by Q4 2026.
The 11.4% one-day move sets a psychological anchor. Institutional investors who missed the print will watch Q2 carefully. Guidance reaffirmation at the July print could push the stock toward 210 to 220 in the near term before multiple really gets tested.
Bull case. Software-defined vehicles are a decade-long structural growth driver. NXP's S32 platform is standardized at BMW, GM, and Volkswagen, 3 of the world's highest volume vehicle programs. Every model refresh locks in higher ASP NXP silicon for 7 to 10 years.
Data center optionality is the incremental bull argument. A 200 to 500 million inflection in 1 year, 150% growth, in a segment that is 12% of revenue, creates upside that consensus models are still underweighting.
Margin expansion compounds the bull thesis. 60% gross margin by 2028 adds approximately 400 million in annual gross profit versus today. At 14 times EBITDA, that margin expansion alone supports a $15 to $20 higher stock price.
Bear case. Rivals including Texas Instruments, ON Semiconductor, and Microchip Technology are not standing still. TXN's $40 billion balance sheet and industrial automation exposure means NXP is competing against a well-resourced opponent in every segment where it is growing.
China substitution is the specific bear trigger. If BYD Semiconductor or a Huawei automotive chip division captures radar share at Chinese OEMs, where NXP earns 39% of total revenue, the financial model breaks without an offsetting ramp in the US and Europe.
The CEO transition adds a valuation discount that has not fully resolved. Sotomayor needs 2 to 4 clean execution quarters before the uncertainty premium contracts, and the multiple can expand toward 15 to 17 times.
The margin expansion path to 60% gross margin is the highest stakes projection. BSMC and ESMC joint ventures are not fully operational. 200 basis points of gross margin improvement adds 500 million in annual gross profit if achieved, but it is not yet proven in the results.
Bottom line, NXP delivered as beat, a MEMS explained revenue miss, and Q2 guidance that earned the 11% stock pop. The data center inflection is real, the SDV thesis is executing, and the balance sheet is improving. At 14.3 times forward earnings with 35% analyst upside, the risk-reward is favorable if China holds and Sotomayor executes cleanly.
The number to watch is Q2 Communications Infrastructure segment revenue. If that line runs at 400 million or above for Q2, the 500 million full-year data center target is on track and the thesis advances. Results drop in mid-July. That is NXP Semiconductors Q1 2026 on Charged Alpha.
Charged Alpha is for informational and educational purposes only and does not constitute financial, investment, or tax advice. Securities mentioned are for educational discussion only and are not buy or sell recommendations. All content reflects publicly available information and the views of the hosts. Past performance is not indicative of future results. Always conduct your own research or consult a licensed financial advisor before making any investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.